I'm with Ron William, founder and principal market strategist at RW Market Advisory. Great to have you with us, as always, Ron. Let's start out by looking at the S&P 500. You've got a chart you want to take us through. It's having trouble breaking above its crisis peak, which was back in 2008.
Well, absolutely. And one of the big lessons that we learn is that markets tend to have a price and time memory, a collective memory from the past. And certainly the S&P 500 is no exception, having rallied into its 2008 crisis peak around 1440. Now that level is still creating formidable resistance, but also if we look at the time side of things, the bear market rally, which I'm calling from 2009, is still part of a bear market rally from the structural bear market, has lasted more than the average cycle of around 44 months. So that's suggesting some exhaustion, both in price and time terms. That one very last point I'll make is that if you look at the market internals, in terms of the stock participation in the S&P 500, that's quite weak. And that's been led by mega cap stocks such as Apple, for example. And as we all know, that's down about 11% from its record highs. Interesting.
Now, when you look at sort of Europe versus the U.S., how do you see stock markets playing out for the rest of the year?
Well, I think this is the really big story to come, which many people probably aren't pricing in, and that is that Europe has already had a very sharp fall if we look at the peripheral markets, Spain, Italy, and Portugal. And if we look at the stocks 600 versus the S&P 500 as a proxy, that is looking very overextended. US has done significantly better, but I think that story is about to turn into the end of the year in early 2013.
So we could actually see European stocks outperforming U.S. stocks in the coming weeks and months?
Yes, that's one of the options. I would say stabilize first and then potentially outperforming as well.
Okay, let's move on to your next chart. Gold headed lower, is that right?
Gold heading lower, having had an impressive bull run, about 10% in the last 5 weeks, so a lot of good upside. But as with all markets, any acceleration is unsustainable in the short term, and so gold has pretty much taught that lesson. We've seen what happens afterwards in historical examples. February peak of this year and the November peak of 2011. You can see the market had a very sharp upside and then had to kind of recover on the downside. The key target there is the 200 moving average at around 1660.
If it goes through that, it'll fall further.
Yes.
Interesting, though, because most people we speak to are calling gold higher, I guess, perhaps in the longer term.
Well, this is it. Timing is everything, and in the longer term, I'm very much still bullish on gold, but at the moment we have to look at the price dynamics, and we are very overextended, and hence we're seeing some unwinding from those levels. I think also gold has been playing more of the risk market as opposed to the safe haven play, so we must keep that in mind when we're looking at these proxies.
Let's have a look at Euro-US dollar. It could fall below its 200-day moving average.
Yes, and the long-term moving average is a great proxy for most of the markets. A lot of people are watching these levels. And what I've said on Eurodollar is we've had the summer rally extend, but then hit that key level around 130, 120, which is a key resistance level. Now we're oscillating around that 200 moving average, and the key message there is expect a large amount of stop and option barriers around that level. So a lot of trend followers will be looking to kind of gauge their directional bias as to what happens on that level. If we break beneath that, then we could see...
And that level about what, 128.30?
Yes, exactly. 128.30 would be another support level if we break that 200-day moving average.
And it could, if it goes through that 200-day moving average, 124.60 would be the next resistance?
Yes, yes.
And long term on the euro, are you bearish?
I'm more bearish, and I think, and I would say probably try and quantify that and say the next few months I'd be bearish, looking for the other side of the equation, the dollar side of the equation, to gain in value on the back of potential renewed safe haven flows as volatility tends to increase, probably in the month of November ahead of the US elections. And the big issue is a lot of people have been looking for high volatility this month. It hasn't happened, so it might come in the weeks ahead.
Okay, and the U.S. election, anything you're looking at particularly with regard to that coming up?
Well, I still think if we look at historical price performance, that markets tend to rally pre-election, the famous U.S. pre-election rally. But I do think that we should be cautious for a potential setback before the elections, which might still allow for that rally setup. But a lot of people have been pricing in a rally from now until then. We need to keep in mind that there might be a small short circuit in the market.
We don't have a crystal ball, Ron William, but we do have the chart.
Yes,
Thank you very much for being with us.